Question 1. Scenario-based question. Topic: Claims process and procedures. Mr. Anderson owns a small business in North Carolina. After a severe storm, his commercial property suffers significant damage and he promptly files a claim with his insurance company. The insurer conducts an investigation and offers a settlement amount. Mr. Anderson believes the offered amount is insufficient to cover the damages. The insurer insists that its evaluation is final. What should Mr. Anderson do to dispute the settlement amount under North Carolina law? A. Accept the settlement amount offered by the insurer and file a lawsuit afterward to recover additional damages. B. Request an independent appraisal to determine the value of the loss and invoke the policy's appraisal clause. C. Contact the North Carolina Department of Insurance to have the DOI adjust a claim settlement. D. File a formal complaint with the insurance company's claims manager and wait for their response. Answer B. Explanation. Under North Carolina law, if a policyholder disputes the insurer's settlement offer, they have the right to invoke the appraisal clause of their insurance policy. The appraisal process allows both parties to appoint their own appraisers, who will then agree on the value of the loss or bring in an umpire if they cannot agree. Filing a lawsuit, option A, is not the first step in dispute resolution and could result in higher legal costs. Carolina DOI, option C, does not adjust claims but may intervene if there are regulatory violations. Filing a complaint with the insurer, option D, is a valid step but will not resolve valuation disputes through a formal process like the appraisal clause. Question 2. Topic: North Carolina state insurance laws and regulations. Which of the following actions would be considered a violation of North Carolina's unauthorized insurers regulations? A. Licensed producer in North Carolina sells policy from an insurer that is not authorized to conduct business in the state. B. Licensed producer renews client's policy with an authorized insurer after confirming the company's status with the North Carolina Department of Insurance. C. North Carolina resident purchases surplus lines policy through licensed surplus lines broker. D. Licensed producer files report with the North Carolina Department of Insurance regarding the financial status of an insurer they represent. Answer A. Explanation. North Carolina law prohibits producers from selling insurance policies from unauthorized insurers, meaning insurers that are not licensed to conduct business in the state. Selling policies from unauthorized insurers is a serious regulatory violation and can lead to fines, license suspension, or revocation. Option B describes a proper renewal process with an authorized insurer. Option C is permissible when purchasing surplus lines insurance through a licensed broker, as surplus lines insurers are exempt from certain regulations but still require proper broker involvement. Option D is a legitimate action that producers should perform when required by law. Question 3. Topic: Policy provisions and contract law. Which of the following scenarios demonstrates a valid reason for an insurer to cancel a personal auto insurance policy in North Carolina? A. The insured has recently moved to another state and no longer resides in North Carolina. B. The insured has accumulated multiple speeding tickets over a period of 5 years. C. The insured failed to pay the premium by the due date. D. The insured added a teenage driver to their policy, increasing the risk exposure for the insurer. Answer C. Explanation. Under North Carolina insurance laws, insurers may cancel a personal auto insurance policy for specific reasons, including non-payment of premium. This is a valid ground for cancellation provided the insurer follows the notice requirements outlined by law. Option is not a valid reason for immediate cancellation but may require a policy adjustment. Option B refers to traffic violations, which may lead to higher premiums but do not necessarily result in cancellation unless they significantly impact the insurability. Option D involves an increased risk, which insurers address through premium adjustments rather than policy cancellation. Question 4. Scenario-based question. Topic: Ethical practices and market conduct. MS Tanner, a licensed insurance producer in North Carolina, is meeting with a potential client, Mr. Collins. During the meeting, MS Tanner exaggerates the benefits of a life insurance policy and claims it will guarantee higher returns than any other investment option. She also advises Mr. Collins to cancel his existing policy immediately and switch to her policy, claiming it is the best policy on the market. Which unethical practice is Tanner engaging in, according to North Carolina insurance regulations? A. Twisting. B. Rebating. C. Misrepresentation. D. Churning. Answer A. Explanation. Twisting is the unethical practice of inducing a policyholder to cancel or lapse an existing policy by providing misleading information about the new policy's benefits. Ms. Turner's actions qualify as twisting because she advises Mr. Collins to cancel his current policy and switch to her policy based on false or exaggerated claims. Option B, rebitting, refers to offering unauthorized incentives to clients to purchase insurance. Option C, misrepresentation, involves providing false or misleading information but may not specifically include advice to switch policies. Option D, churning, involves using policy values to purchase additional policies for the producer's financial gain. Question 5 topic, North Carolina specific insurance requirements. In North Carolina, what is the minimum auto liability insurance coverage required for bodily injury to 2 or more people in a single accident? A. $30,000. B. $60,000. C. $100,000. D. $50,000. Answer B. Explanation. North Carolina law requires drivers to carry minimum auto liability insurance coverage of $30,000 for bodily injury per person, $60,000 for bodily injury per accident, and $25,000 for property damage. These minimum limits are often referred to as 30, 60, 25 coverage. Option A refers to the per person bodily injury limit, while option C exceeds the minimum requirement. Option D does not align with the required coverage amounts. Question 6 topic, insurance producer responsibilities. Which of the following actions by an insurance producer would violate fiduciary responsibilities under North Carolina law? A. Depositing client premium payments into a separate trust account. B. Mixing client premium payments with the producer's personal funds. C. Providing clients with detailed receipt for all premium payments. D. Forwarding premium payments to the insurer within the required time frame. Answer B. Explanation. Under North Carolina law, insurance producers have fiduciary responsibilities to handle client funds with care. Mixing client premium payments with personal funds commingling is a serious violation of these responsibilities. Producers must keep client funds in a separate trust account and forward them to the insurer promptly. Options A, C, and D represent correct practices that comply with fiduciary responsibilities. Question 7 topic, claims process and procedures. Under the Unfair Claims Practices Act in North Carolina, which of the following would be considered an unfair claim settlement practice by an insurer? A. Denying a claim after conducting a thorough investigation. B. Failing to provide a reason for denying a claim within a reasonable time. C. Settling a claim for an amount agreed upon by both parties. D. Offering a settlement based on policy terms and conditions. Answer B. Explanation. The Unfair Claims Practices Act in North Carolina outlines actions that are prohibited for insurers. Failing to provide a reason for denying a claim within a reasonable time is considered an unfair practice. Insurers must act in good faith, conduct timely investigations, and communicate clearly with claimants. Options A, C, and D describe appropriate claim settlement practices that comply with the law. Question 8 topic, types of insurance policies. Which of the following types of insurance would provide coverage for damage to a client's business property caused by a flood if no additional endorsements were purchased? A. Homeowners insurance. B. Commercial general liability CGL insurance. C. Business owners policy BOP. D. None of the above. Answer D. Explanation. Standard homeowners policies, commercial general liability policies, and business owners policies BOP do not cover flood damage unless a specific flood insurance endorsement is purchased. Flood insurance is typically offered through the National Flood Insurance Program, NFIP, or other private insurers. Option D is correct because none of the listed policies provide automatic flood coverage. Question 9 topic, policy provisions and contract law. Which of the following policy provisions allows an insurer to cancel a policy midterm for material misrepresentation by the insured? A. Insuring agreement. B. Conditions. C. Exclusions. D. Endorsements. Answer B. Explanation. The conditions section of an insurance policy outlines the rights and responsibilities of both the insurer and the insured. Material misrepresentation by the insured is a valid reason for the insurer to cancel a policy midterm. The insuring agreement, option A, outlines the coverage provided. Exclusions, option C, specify what is not covered by the policy. Endorsements, option D, modify the policy but do not relate. Cancellation for material misrepresentation. Question 10 topic, North Carolina state insurance laws and regulations. Which of the following scenarios would require a temporary insurance license in North Carolina? A. A licensed producer moving from another state to North Carolina. B. The spouse of a deceased producer temporarily managing the producer's insurance business. C. Producer who failed to meet continuing education requirements. D. An adjuster working on large catastrophe claim in North Carolina. Answer B. Explanation. North Carolina allows temporary licenses to be issued in certain situations, such as when a producer dies, becomes disabled, or enters military service, to allow someone such as a spouse to manage the producer's business temporarily. This ensures that clients are still served during the transition period. Options and C are not valid reasons for temporary license. Option D refers to emergency adjuster licenses, which are separate from temporary licenses. Question 11, scenario-based question. Topic, claims process and procedures. Mr. James owns a small business in North Carolina and recently experienced a theft at his office. He immediately reported the loss to his insurance company. However, 2 weeks later, the insurer denied his claim, stating that Mr. James failed to submit a proof of loss form within the required time frame. Mr. James claims he was never informed of this requirement. According to North Carolina's Unfair Claims Practices Act, did the insurer act appropriately? Yes, the insurer has the right to deny the claim if the proof of loss is not submitted. B. No, the insurer must provide reasonable assistance to the policyholder in submitting the required forms. C. Yes, the insurer can deny any claim if policy requirements are not met, regardless of notice. D. No, the insurer must investigate the claim before denying it for procedural reasons. Answer B. Explanation. Under North Carolina's Unfair Claims Practices Act, insurers are required to provide assistance and guidance to policyholders in filing claims. Failing to inform Mr. James of the requirement to submit proof of loss form and then denying the claim is considered an unfair practice. Insurers must act in good faith and provide reasonable instructions to claimants. Options and C are incorrect because insurers cannot deny claims solely on procedural grounds if the policyholder was not informed of the requirements. Option D is incorrect because the issue is not about investigation but about procedural fairness. Question 12 topic, insurance terms and definitions. Which of the following best describes subrogation in an insurance contract? A. The process by which an insurer denies a claim for lack of coverage. B. The insurer's right to recover loss from third party responsible for the damage. C. The policyholder's right to cancel policy within the free look period. D. The process by which claim is settled through arbitration. Answer B. Explanation. Subrogation refers to the insurer's right to seek reimbursement from third party responsible for causing the policyholder's loss after the insurer has paid the claim. For example, if an insured's car is damaged in an accident caused by another driver, the insurer may pursue the other driver's insurer for reimbursement. Options A, C, and D are unrelated to the concept of subrogation. Question 13 topic, North Carolina state insurance laws and regulations. In North Carolina, what is the maximum fine that the Department of Insurance can impose on a licensed producer for each violation of insurance regulations? A. $1,000. B. $5,000. C. $10,000. D. $25,000. Answer C. Explanation. The North Carolina Department of Insurance has the authority to impose fines of up to $10,000 per violation for licensed producers who violate insurance regulations. This penalty serves as a deterrent to unethical behavior. Low fines such as $1,000 or $5,000 may be applied for less severe violations, but $10,000 is the maximum allowed penalty per violation. Option D is incorrect because it exceeds the state's allowed limit. Question 14 topic, policy provisions and contract law. Which of the following is not typically found in the conditions section of an insurance policy? A. The requirement to notify the insurer of a loss. B. The policy's effective dates. C. The insured's duties after loss. D. The insurer's right to cancel the policy. Answer B. Explanation. The policy's effective dates are found in the declarations page, not in the conditions section. The conditions section outlines the responsibilities of both the insured and the insurer, including duties after loss, notification requirements, and cancellation provisions. Options A, C, and D are all typically part of the conditions section. Question 15 topic North Carolina specific insurance requirements. Which of the following insurance policies is required to participate in North Carolina's coastal property insurance pool beach plan? A. Homeowners insurance policy. B. Flood insurance policy. C. General liability policy. D. Auto insurance policy. Answer A. Explanation. The North Carolina Coastal Property Insurance Pool, also known as the Beach Plan, provides property insurance coverage for properties located in designated coastal areas where private insurers may be reluctant to provide coverage. Homeowners policies in these areas may be required to participate in this plan. Flood insurance, option B, is separate and typically purchased through the National Flood Insurance Program, NFIP. Options C and D are unrelated to property coverage. Question 16 topic Claims process and procedures. Which of the following would be considered an unfair claim settlement practice under North Carolina insurance law? A. Denying a claim after thorough investigation shows the claim is not valid. B. Failing to affirm or deny coverage within a reasonable time frame after receiving a claim. C. Offering to settle a claim for an amount lower than the policy limits. D. Investigating a claim after a policyholder submits a fraudulent claim. Answer B. Explanation. Under the Unfair Claims Practices Act, insurers must respond to claims promptly and communicate clearly with the policyholder. Failing to affirm or deny coverage within a reasonable time frame is considered an unfair claim settlement practice. Options A, C, and D describe legal actions by insurers. Question 17 topic Types of insurance policies. Which type of professional liability insurance is most suitable for a medical doctor to protect against claims of malpractice? A. General liability insurance. B. Errors and omissions EO insurance. C. Directors and officers DO insurance. D. Medical malpractice insurance. Answer D. Explanation. Medical malpractice insurances, a type of professional liability insurance specifically designed for healthcare professionals, such as doctors, to protect against claims of negligence resulting in injury or death. Errors and omissions EO insurance, option B, applies to professionals like accountants or insurance agents, while directors and officers DO insurance, option C, protects executives and board members from liability claims. Question 18 topic North Carolina state insurance laws and regulations. Under North Carolina law, how often must insurance producers complete continuing education requirements to maintain their license? A. Every 2 years. B. Every 3 years. C. Annually. D. Every 5 years. Answer A. Explanation. North Carolina requires licensed insurance producers to complete continuing education requirements every 2 years. This ensures that producers remain updated on regulatory changes and industry practices. Options B, C, and D are incorrect as they do not align with North Carolina's licensing requirements. Question 19 topic Consumer protection laws in North Carolina. Which of the following organizations provides financial protection to policyholders in North Carolina if an insurer becomes insolvent? A. North Carolina Department of Insurance. B. North Carolina Insurance Guarantee Association. C. National Flood Insurance Program. D. Federal Deposit Insurance Corporation. Answer B. Explanation. The North Carolina Insurance Guarantee Association provides financial protection to policyholders if an insurance company becomes insolvent. It covers certain claims and ensures continuity of coverage. The Department of Insurance, option A, regulates insurance companies but does not provide financial protection. Options C and D are unrelated to this type of protection. Question 20 topic Adjuster licensing and regulations. Which of the following is not a type of adjuster license recognized in North Carolina? A. Public adjuster. B. Staff adjuster. C. Independent adjuster. D. Legal adjuster. Answer D. Explanation. North Carolina recognizes public adjusters, staff adjusters, and independent adjusters, but legal adjuster is not a recognized license type. Public adjusters represent policyholders, staff adjusters work for insurers, and independent adjusters are contracted by insurers to handle claims. Question 20 on scenario-based question. Topic Ethical practices and market conduct. MS. Linda Morrison is an insurance producer in North Carolina. She is approached by a client who expresses interest in purchasing a homeowner's policy. During the conversation, the client mentions that she has also been speaking with another producer about a similar policy. In an effort to close the deal, Linda tells the client that she will reduce her commission and provide part of the savings to the client in the form of a discount on the premium. Under North Carolina law, which of the following best describes Linda's actions? A. Acceptable as long as the discount is disclosed to the insurer. B. Prohibited as it constitutes rebating, which is illegal in North Carolina. C. Allowed, but only if the client agrees in writing. D. Acceptable under certain conditions, provided the discount is less than 5% of the premium. Answer. B. Explanation. Under North Carolina's Unfair Trade Practices Act, rebating is strictly prohibited. Rebating occurs when producer offers part of their commission or any other incentive to client to induce them to purchase an insurance policy. Option is incorrect because disclosing the discount to the insurer does not make rebating legal. Options C and D are also incorrect because North Carolina law does not permit rebating under any circumstances. Question 22 topic: General insurance concepts. Which of the following statements best describes adverse selection? A. It is the process by which insurers select high-risk applicants for coverage. B. It occurs when individuals with a high risk of loss are more likely to purchase insurance than those with low risk. C. It refers to the practice of insurers charging higher premiums to policyholders with poor credit scores. D. It is the process by which insurers transfer risk to reinsurers to mitigate financial losses. Answer. B. Explanation. Adverse selection occurs when individuals with a higher risk of loss are more likely to seek insurance coverage, which can result in higher than expected claims for insurers. Insurers manage this risk by using underwriting techniques to ensure that premiums reflect the risk profile of the insured. Option is incorrect because insurers aim to avoid selecting high-risk applicants without proper risk assessment. Options C and D refer to other insurance practices unrelated to adverse selection. Question 23 topic: Policy provisions and contract law. Which of the following is an example of a unilateral contract in the context of insurance policies? A. Both parties agree to perform certain obligations under the contract. B. Only one party, the insurer, makes a legally enforceable promise. C. Both parties must fulfill specific duties to make the contract valid. D. The insured must pay a premium before the insurer has any obligations. Answer. B. Explanation. An insurance policy is a unilateral contract because only the insurer makes a legally enforceable promise to pay for covered losses. The insured is not legally obligated to file claims or renew the policy but must pay premiums to keep the policy active. Options and C describe bilateral contracts, and option D refers to premium payments, not the nature of the contract. Question 24 topic: North Carolina specific insurance requirements. Which of the following is the minimum auto liability coverage requirement in North Carolina for bodily injury per person? A. $15,000. B. $25,000. C. $50,000. D. $100,000. Answer. B. Explanation. In North Carolina, the minimum auto liability coverage requirement is $25,000 for bodily injury per person, $50,000 for bodily injury per accident, and $25,000 for property damage. These limits are commonly referred to as 25, 50, 25. Options A, C, and D do not match the state's legal requirements. Question 25 topic: Insurance producer responsibilities. Which of the following is not considered a fiduciary responsibility of an insurance producer in North Carolina? A. Safeguarding premium funds received from clients. B. Keeping accurate records of all transactions. C. Using client funds for personal expenses if they are reimbursed later. D. Acting in the best interests of the client. Answer. C. Explanation. Insurance producers have fiduciary responsibilities, which include safeguarding client funds, maintaining accurate records, and acting in the client's best interests. Using client funds for personal expenses, even if reimbursed later, is strictly prohibited and constitutes embezzlement. Options A, B, and D are all examples of appropriate fiduciary behavior. Question 26 topic: Claims process and procedures. Which of the following best describes the purpose of appraisal provisions in an insurance policy? A. To allow the insurer to cancel a policy at any time. B. To provide a method for resolving disputes over the value of a claim. C. To require the policyholder to submit a proof of loss. D. To outline the duties of the insured after a loss occurs. Answer: B. Explanation. Appraisal provisions are included in many insurance policies to provide a method for resolving disputes over the value of a claim. If the insured and the insurer disagree on the amount of loss, each party may appoint an appraiser and an umpire is selected to resolve the dispute. Options A, C, and D refer to other policy provisions unrelated to appraisals. Question 27. Topic: Ethical practices and market conduct. Which of the following would be considered an illegal practice under North Carolina's Unfair Trade Practices Act? A. Recommending suitable insurance policy to client based on their needs. B. Misrepresenting the terms of an insurance policy to potential client. C. Offering to provide continuing education courses to clients. D. Denying claim after thorough investigation. Answer: B. Explanation. Under North Carolina's Unfair Trade Practices Act, misrepresentation of policy terms, benefits, or conditions to potential client is illegal. Insurers and producers must accurately represent all aspects of an insurance policy. Options and D describe legal practices, while option C does not violate any regulations. Question 28. Topic: Types of insurance policies. Which of the following is not typically covered under a commercial general liability CGL policy? A. Bodily injury caused by the insured's operations. B. Property damage caused by the insured's products. C. Professional errors made by the insured. D. Personal injury caused by advertising practices. Answer: C. Explanation. Commercial general liability CGL policies do not typically cover professional errors or omissions. Professional liability insurance or errors and omissions (EO) insurance is required for such coverage. CGL policies cover bodily injury, property damage, and personal injury claims. Options A, B, and D are correct descriptions of CGL policy coverage. Question 29. Topic: North Carolina state insurance laws and regulations. How long must insurance producers in North Carolina retain records of their transactions with clients? A. 1 year. B. 3 years. C. 5 years. D. 7 years. Answer: B. Explanation. North Carolina law requires insurance producers to retain records for at least 3 years from the date of the transaction. This ensures compliance with state record-keeping requirements. Options A, C, and D are incorrect based on state-specific regulations. Question 30. Topic: Consumer protection laws in North Carolina. Which of the following is an anti-discrimination law in insurance practices in North Carolina? A. Insurers can deny coverage based on pre-existing conditions. B. Insurers cannot refuse coverage based on race, color, national origin, or religion. C. Insurers can adjust premiums based on gender. D. Insurers are allowed to cancel policies for any reason within 30 days. Answer: B. Explanation. North Carolina has anti-discrimination laws that prohibit insurers from refusing to provide coverage based on race, color, national origin, or religion. These laws ensure fair and equitable treatment of all individuals seeking insurance. Options A, C, and D describe practices that may violate consumer protection laws.